Good morning, Mr. Rao.
Good morning.
Good morning, everybody. On behalf of Business Standard, let me extend a very warm welcome to the Reserve Bank of India Deputy Governor, Mr. M. Rajeshwar Rao, on the second and the final day of Business Standard BFSI Insight Summit. Mr. Rao was appointed Deputy Governor of the Reserve Bank of India in October 2020. He oversees matters related to regulation, risk monitoring, internal audit, enforcement, and legal affairs. He has spent almost 4 decades at the RBI in various departments, including financial market operations, internal debt management, and foreign exchange management. As Executive Director, he was RBI's representative on the Markets Committee of the BIS. Many thanks, Mr. Rao, for joining us remotely today, even though you have some pressing and urgent matters to attend to. May I please request you to address this audience and thousands of others who are watching this summit's proceeding online, and please share your views on challenges and opportunities in scaling up green finance. Thank you very much. Over to you, Mr. Rao.
Thank you. Very good morning to all the distinguished dignitaries and participants at the BFSI Insight Summit being organized by the Business Standard. I am very happy to be amidst you, albeit virtually. In the recent time, this event has become a well-regarded platform for debates and deliberations on contemporary issues in finance and has generated useful insights with the wisdom of distinguished speakers who have graced this previous summits. As we look back over the past decade and a half, what is really striking is the fact that the financial sector has been buffeted by several financial storms which it has manfully weathered. After each episode, the endeavor has been to ensure that the institutions emerge stronger and more resilient so as to support the continuing narrative of recovery and growth. The episodes of crisis of late have become more frequent, with lesser breathing space afforded to the institutions to recover, recoup, and be future ready. The evolving situation demands that both the regulators and the regulated entities remain ever ready and well equipped to face the emerging risks and challenges, be it in the growth of fintech, digitalization of financial services, customer service, or the challenges of data and cybersecurity in the financial services sector. But the key risk or challenge, as you will, which I would like to discuss today, is the impact of climate change and what it can mean for the financial services industry. In a way, I'm revisiting a topic on which I spoke about a year back, climate risk and green finance. While this issue may still be a new kid on the block as far as such deliberations go, it is fast becoming a key issue discussed globally, and the urgency of the situation is more apparent to one and all. At the recent Conference of Parties, the COP27 summit in Egypt, and the United Nations Environment Programme's Emission Gap Report of 2022, the closing window released in October 22, have brought once again to the fore the global attention on the measures required and the need for urgent action. The hierarchy of action and the agencies responsible for the same is getting crystallized, while there is a greater degree of agreement on the manner in which to proceed further, starting from taking effective steps to reducing carbon emissions, to fostering patterns of production and consumption, and transitioning to a sustainable lifestyle in a cleaner and greener earth. It's also clear that there is no room for differences on the issue, and only our collective efforts can address the challenge of climate change. Having said that, the question that emerges is what would be the roles of the different institutions in achieving these objectives? While the overarching policy approach would be guided by sovereign efforts and coordinated by decision-making bodies such as the COP, the financial world needs to ask the obvious question to itself: how can it help? As custodians of financial stability, central banks and policymakers would also be required to evaluate and examine the instruments or the strategies they should leverage or focus upon to meet the sustainability goals without compromising on the existing policy mandates. There are some of the dilemmas which I would like to highlight in my remarks today. Given its wide-ranging economic and financial implications, the climate-related financial risks are already engaging the attention of international standard-setting bodies, the central banks, and supervisors globally, with a focus on the need to promote the transition to a sustainable global economy. The Reserve Bank, too, had come out with a discussion paper on climate risk and sustainable finance earlier this year. Besides, it had also undertaken a survey on climate risk and sustainable finance to assess the approach, the level of preparedness, and progress made by the leading scheduled commercial banks in managing climate risk. This has provided useful insights, and the feedback from this exercise will help in shaping the regulatory and supervisory approach of the Reserve Bank to climate risks and sustainable finance. There is a general consensus that the banks and financial institutions will play a key role in financing transition to a low carbon economy and supporting the national climate commitments. While no entity is immune from climate risks, we in India are particularly vulnerable to climate change related physical risks, and hence there is a need to be more alive to the urgency of action given our long coastline, high share of fossil fuels in the energy systems, and relatively high dependence of rural livelihoods on agriculture. Climate trends and events have a direct bearing on the economy and resultantly have an impact on the financial institutions and the financial system. According to a report, the transformation of the global economy needed to achieve net zero emissions by 2050 would be universal and significant, requiring almost US $9.2 trillion in average annual spending on physical assets, which is $3.5 trillion more than what is being spent today. In the case of India, the Council on Energy, Environment and Water has already estimated that a cumulative investment of US $10 trillion would be needed to meet our net zero commitments by 2070. This underscores the urgency of efforts for transitioning to a low carbon economy. Ensuring access to adequate transition finance and supporting technology would be critical in this process. Going forward, there are two key aspects which the banks would need to focus on. First, relying on their time-tested expertise in financial intermediation by acting as an effective conduit for channelizing finance to carbon-efficient sectors and industries in alignment with the national policies and goals. And second, improving the management of financial risks in their books, which may originate from climate change. Such risks range from direct physical risk emanating from adverse climate-related events to loss of reputation and legal risks. Obviously, the strategies for mitigating these risks would have to be encompassed by sound public policy objectives, and all stakeholders would need to play their role in helping the country traverse and transform into a climate-resilient economy. In this, of course, there are challenges for the financial intermediaries and banks. Estimating the timing, frequency, and severity of climate-related events is a challenging proposition, given the uncertainties involved in the process. While significant progress has been achieved globally on developing scenarios and forward-looking approaches for modeling climate risks, the requirement of past data and the unpredictable nature of climate change makes estimation of climate events and their financial impact a challenging endeavor. Nonetheless, there is no alternative but to continue working on this path of self-discovery and slowly gain momentum, as we cannot afford to be inactive anymore. The work at the global level, which is being coordinated by the Financial Stability Board and endorsed by the G20, rests on four building blocks needed for addressing climate-related financial risks. These four building blocks are disclosures, data, vulnerability assessment, and regulatory and supervisory practices and tools, which to my mind are prerequisites for a resilient financial system when augmented by informed decision-making. Let me discuss a bit further on these aspects. An appropriate and adequate disclosure framework must have three key attributes. First, it should have intertemporal consistency. Second, it should be comparable. And third, and most important, it should be useful for decision making. Climate-related disclosures by firms that largely contain these attributes would help policymakers in understanding the enormity of the task ahead in terms of the transition funding requirements. Further, this would help banks to understand the level of carbon intensity in the business ventures in case they are to fund them, so that they are able to differentiate and appropriately price in such risks. Internationally, significant body of work has been done on disclosures. The FSB's Task Force on Climate-Related Financial Disclosures and the International Sustainability Standards Board under the IFRS Foundation have been leading this work along with other standard-setting bodies. In March 2022, the ISSB published exposure drafts on its first two proposed standards. The first sets out the general sustainability-related disclosure requirements, while the other specifies climate-related disclosure requirements. Given the global nature of funding markets and cross-border flows of capital, the idea is to agree upon a common global baseline disclosure requirement, which is interoperable among jurisdictions for comparability and consistency. The Reserve Bank, as a part of the standard-setting bodies, has also been contributing and learning from the global discussions and experiences. In our recently published discussion paper on climate risk and sustainable finance, we elaborate on how climate-related disclosures is an important source of information for the different stakeholders, namely the customers, the depositors, investors, as well as the regulators of regulated entities, to understand the relevant risks faced by them and their approach to address such issues. For the corporates, beginning from the current financial year 22-23, SEBI has mandated business responsibility and sustainability reporting for the top 1,000 listed companies by market capitalization in India. The disclosures under the BRSR framework would incentivize green finance and help banks and financial institutions in estimating their exposure to these listed companies. While consistent and comparable disclosures would enable the financial institutions to make firm-level risk assessments, the second building block, data, is required for making macro-level assessment of risks. Like any financial risk, reliable and comprehensive data on climate risk-related exposures would aid in making sound policy interventions and undertaking climate scenario analysis and stress testing for the assessment of risks from climate events. This, however, is easier said than done. While global efforts are underway to create data repositories and provide guidance on collection of data for better comparability, availability of high-quality, granular, and sufficient data remains a challenge as of now. Availability of granular data also remains crucial for modeling the forward-looking nature of climate events and developing matrices for monitoring climate-related financial risks. The third building block, vulnerability assessment, is again a macro-level exercise to understand the financial stability risks arising from climate events and their impact on the financial systems. It is focused on analysis and stress testing using various scenarios to help in better assessment of the potential pressure points in the financial system and in understanding the linkages between the financial sector and the real sector. Excuse me. While the development of climate scenario analysis and stress testing scenarios and analytical tools are still in their infancy, the need for integrating them with the regular monitoring exercises and overall financial risk assessment has been well recognized. One particular challenge in modeling climate-related risks is the long time horizon which has to be considered. The climate events may often span across decades, if not centuries, and this may make the data collection exercise quite difficult and the outcomes more uncertain to predict. The fourth and final building block, consisting of initiatives which are being undertaken or planned by the regulators and supervisors to facilitate transition. In a way, this is a culmination of the work taken up under the three building blocks discussed above. The regulators may need to fine-tune the existing prudential policies to integrate the climate risks into the regulatory framework. At the same time, from a supervisory perspective, the expectations may have to be set and communicated to all the regulated entities regarding the climate-related risks, encompassing the organizational strategy, the governance, risk management, and assurance functions. The global efforts undertaken so far seems to suggest that integrating climate-related risks and capturing them by fine-tuning existing prudential frameworks may be possible. The Basel Committee on Banking Supervision has published principles for effective management and supervision of climate-related financial risks in June 2022. Further, in October 2022, the Financial Stability Board published its final report on supervisory and regulatory approaches to climate-related risks. Earlier in March 2022, the Network for Greening of Financial Systems published a statement on the nature-related financial risks, which acknowledges that the failure to account for, mitigate, and adapt to the nature-related risks could have significant macroeconomic implications and become a source of financial stability risk. While guidance has been made available, regulated entities may need time, resources, and capacity to integrate climate-related considerations into their decision-making frameworks and customer-facing business lines. Let me briefly touch upon some of the private sector initiatives that have been seen so far. In the private sector, decarbonization and digitalization are emerging as mega trends that could compel sectors and corporates to undertake structural changes and fundamentally alter their traditional business models. It is heartening to note that some of the leading Indian companies in the hard-to-abate sectors, like the steel and cement, for example, are working on ambitious decarbonization agenda aimed at reducing the carbon footprint in their production process. Banks and financial institutions may have to step up their engagement with their corporate customers on ensuring sustainability-focused financing and other support services to help them transition towards a low-carbon economy while reducing their own carbon footprint. The financial sector can channel resources towards green projects and businesses by offering suitable and customized products to the businesses. Over the past 3 years, the sustainability-linked bonds and sustainability-linked loans market has been a fast-growing segment globally in the sustainable finance market. India, too, has seen the introduction of green and sustainable finance instruments such as the sustainability-linked loans. Liberalized external commercial borrowing norms have also enabled Indian companies to raise offshore finance through green bonds, social bonds, sustainable bonds, and sustainability-linked bonds. In line with the global trends, the issuance of sustainable debt has risen sharply in India during the calendar year 2021, taking it to the second place among the emerging economies in cumulative green bond issuances. Mechanisms such as blended finance and risk-sharing facilities are also being utilized to finance climate and sustainability-related projects. These initiatives from the financial sector in India and across the globe makes one believe that private sector is very much alive to the challenges that lie ahead of us. Looking at some of the public sector initiatives, I think let me start by saying that to move the needle towards net zero, we must progressively decarbonize all sectors of the economy, including the hard-to-abate ones. This means that we would need to incentivize banks to provide support in terms of transition finance for businesses and sectors that are not so green, to adopt cleaner technologies, increase energy efficiency, and become greener over time. Green finance can play a crucial role in making India's economy resilient to climate change impacts. During the COP26 summit in November 2021, the Honorable Prime Minister had announced that by year 2070, India will achieve the target of net zero. As referred to earlier, per an independent study by the CEW, under a net zero 2070 pathway, India would need cumulative investments of the order of magnitude of US $10 trillion to achieve the net zero emission target by 2070. This would creating an enabling ecosystem for financing India's transition to a green economy. In India, both the government and the Reserve Bank have been participating in the global discussions on climate risks and have already taken up quite a few initiatives. The government, in the Union Budget for 22-23, announced that climate action would be a key priority and proposed that as a part of its overall market borrowings in 22-23, sovereign green bonds will be issued for mobilizing resources for green infrastructure. The proceeds will be deployed in public sector projects, which will help in reducing the carbon intensity of the economy. This by no means is a small step. The sovereign green bonds will provide a pricing reference for the private sector entities in India for their rupee-denominated borrowing for ESG-linked debt. Thus, the issuance of sovereign green bonds would help in creating an ecosystem which fosters a greater flow of capital into green projects and entities undertaking such projects. Recognizing the need for concerted efforts in this area, Reserve Bank has concomitantly set up a sustainable finance group within its Department of Regulation in May 2021 to lead the regulatory initiatives in the area of climate risk and sustainable finance in the Indian context. As I mentioned previously, RBI has already released a discussion paper on climate risk and sustainable finance in July 22, covering a gamut of issues on the RBI's website for comments of the stakeholders. It is heartening to mention that we have received comments from a large number of regulated entities and other stakeholders. I think there are more than 12 to 1300 comments which have been received and which are being examined. These are being carefully examined before we frame any regulatory guidance on climate risks and sustainable finance. Along with the discussion paper, we had also released the result of a survey undertaken to assess the approach, the level of preparedness, and the progress made by leading scheduled commercial banks in India for managing climate-related financial risk. The survey, which covered 12 public sector banks, 16 private sector banks, and 6 foreign banks, provided useful insights, and feedback from this exercise will also help in shaping our regulatory and supervisory approach. Reserve Bank has also concluded a climate vulnerability assessment among the leading banks in India as a pilot exercise. As expertise in modeling climate risks continue to evolve, this exercise would help to develop the capabilities of the bank and the participant institutions. Another notable feature in our financial ecosystem is that while the rest of the world is still grappling in developing new instruments to funnel green funding to the green and sustainable companies and projects, we already have a well-accepted incentive-based instrument in terms of the priority sector lending norms to encourage lending to such projects. Over the years, we have been taking various policy measures to promote and support green finance initiatives through this route. For example, renewable energy projects have been included as part of the priority sector lending in 2022. Further, in 2012, Reserve Bank included loans sanctioned directly to individuals, for setting up off-grid solar and other off-grid renewable energy solutions for households. And in 2015, the priority sector lending criteria was expanded to include bank loans up to the limit of rupees 15 crores to individual borrowers for purpose of solar, mass-based power generators, windmills, micro-hydel plants, and for non-conventional energy-based public utilities, that is, the street lighting systems and remote village electrification. In 2020, this limit for bank loans was doubled to rupees 30 crores. It is heartening to note that in the recent years, leading banks in India have begun stepping up their exposure to the renewable energy sector. Just to briefly focus on enablers for scaling up green finance in India, I would like begin by saying that the banks and financial institutions have been the backbone of India's economic growth. And as the country pivots to sustainable growth, they will have to take a lead and accelerate green lending. To support this acceleration, a number of structural changes would be needed in the traditional lending approach, including evaluation and certification of the green credentials of projects. In order to give focused attention on scaling up green finance, banks and financial institutions would have to invest in human resources and capacity building, as well as to integrate environmental and social risk considerations into their corporate credit appraisal mechanisms. A formal definition of green finance, along with a taxonomy, is the need of the hour, as it would enable more precise tracking of financial flows to the green sectors in India, which in turn would help to design effective policy, regulations, and institutional mechanisms directed towards increasing both public and private investments. A taxonomy would also help the banks and financial institutions in better assessing the climate risk in their loan portfolio, scaling up green and sustainable finance, and mitigating the risks of greenwashing. Another key challenge in scaling up green finance is the availability of a robust ecosystem for third-party verification and assurance, and impact assessment and the green assessment of the green credentials of businesses and projects. This would also address greenwashing concerns and ensure unhindered flow of capital and funding to the entities. The challenge regarding the availability of data and disclosures would also need to be addressed quickly. In this context, the disclosure standards prescribed by SEBI for the top 1,000 listed entities by market capitalization is a welcome step. I am confident that the listed entities would not only adhere to the mandatory disclosures, but would also not hesitate to follow those which are also additional and voluntary in nature. Green finance must be scaled up rapidly to meet India's climate targets under the updated nationally determined contributions communicated to the United Nations Framework Convention on Climate Change in August 2022. The enhanced ambition requires mobilization of green finance at a much faster pace. For example, green infrastructure investment trusts could help to scale up green finance as also deepen the local bond market. But in the end, all these ideas need a clear intent from all stakeholders in order for it to be implemented and sustained. To sum up, climate change may result in physical and transition risks that could have implications for physical safety and financial soundness of individual regulated entities, as well as for the stability of the financial system. Thus, there is a need for regulated entities as well as for regulators to develop and implement comprehensive frameworks for understanding and assessing the potential impact of climate-related financial risks in their business strategy and operations. We need to be conscious that the climate risk is the biggest challenge confronting us, and addressing it decisively is our joint responsibility. Financial sector has a key role to play, as it is the sector which finances business and can influence their activities. Banks would have their role cut out in handholding the businesses and arranging for transition finance required for the firms as they shift their strategies to make them more sustainable and planet-friendly. The central banks can play a significant role in shaping the response of the financial sector to the challenges posed by the risks emerging from climate change through appropriate guidance and regulations. The Indian economy is at a stage where we need to grow rapidly, but the challenge before us is to think of ways to incorporate climate risk and ESG-related considerations into commercial lending and investment decisions, while simultaneously balancing the needs of credit expansion, economic growth, and social development. Collective engagement would help to build on our early progress and go a long way in addressing the challenges of climate change. Let me conclude now and leave you with these points to ponder as you continue with your deliberations during the course of the ensuing discussions at the event. Thank you for inviting me to share my thoughts at this summit, and thanks for a patient hearing. Jai Hind.
Thank you, Mr. Rao, for vividly painting the picture of climate-related financial risks. On this note, I'd like to invite on stage Mr. Dobal to render the vote of thanks and also capitulate the key takeaways from the conversation. Over to you, Mr. Dobal.
Thank you so much, Mr. Rao, for a very insightful and informative address. It's very difficult to sum up the address since it was very expansive, and I'm sure this audience and thousands who are watching this program live will have their own takeaways, points to ponder, as you said. For me, in a nutshell, what you laid down very simply is how climate risk is the biggest risk, and what is the ecosystem that we need to build for it, how regulators and regulated entities need to be eternally vigilant, and the evolving mechanisms of climate finance. You spoke about COP27, how the measures and methods are being crystallized only now, the importance of sustainable finance, reliable data on climate finance, how financial stability risk is dealing with the climate finance stress tests, time and resources needed for regulated entities to adopt, and you spoke about the SEBI new rule of disclosures for top 100 companies, the transition of India into green finance and how regulators like RBI can aid to that, the sovereign green bonds and how they could be benchmarked, or they will be the benchmark for even private sectors to come up with. Structural changes needed in green finance. You laid down the whole framework through which sustainable green finance can work, the need for scaling up and so much more. Thank you so much once again. We're very grateful for you for doing that for us. Thank you, Mr. Rao. Thank you so much.
Thank you. Namaskar.
Namaskar.